our very recent sale of Roku. So we're going to walk through a little bit of the history, our history with the position, and then what has ultimately led us to sell. So going back just under 2.5 years ago, in February 2024, we invested our first initial position into Roku. So before our initial purchase, how long have you been following the company, and what really made you decide that it's something we needed to own at that time?
Yeah, I'd been following the company for about a year, but had known about been following the stock in the business for about a year, but had known about the company for several years. I think like every house I've ever lived in has basically had a Roku. So I was aware of what they did and how they kind of played in the streaming landscape. During COVID, the stock went on an absolute tear as everybody was staying at home. More people were buying TVs, upgrading TVs, and streaming really took hold of what people were viewing at the time. And so during COVID, the stock went parabolic basically to over $300 a share. And then over the subsequent couple of years, as less hours were viewed or just the amount of demand for streaming content sort of normalized post COVID surge, the stock declined significantly because people basically extrapolated the 2021, 2022 time period into perpetuity when there was a normalization that was bound to happen. So then the stock pulled back from like 300 to around 60, and I had been following it. I knew it was a good business, but when I took a deeper dive, the thing that I like to find in a business is when something is obscuring like the profitability and some sort of inflection is going to happen. And Roku has two different business models. One's on their, like, they call them dongles, or maybe their TVs, where they basically sell those at a loss because they use that to then generate the views on the TV, where they drive advertising and subscription revenue. So while they lost money on the upfront sale, over the course of the ownership of the dongle or the TV, Roku would have a really attractive return on investment from selling those products. And the loss was obscuring the long-term profitability of the company. And I thought that Roku was nearing an inflection point on the profitability. And that's when I decided to make the initial investment.
Okay. So like when I picture Roku, I'm just picturing like the TV, or like we have the little stick that plugs into whatever TV you have. But I know there's a lot more to the company than that. What were we actually buying by purchasing Roku, and what made that more attractive than other options in that industry?
Yeah, so when we initially bought them, they had, I believe, around 80 million active accounts. So when you turn on your TV, that's a Roku TV, the piece of real estate that is very valuable is what you open up to. So that home screen, it shows the tiles of, do I want to watch Netflix, Amazon Prime, and then there's some advertising components on there. And then when you're not watching anything, they've got what's known as like Roku City, where there's also advertisements in the background when the streaming player is just like idle and you're not watching anything. So we were buying basically an advertising company and a subscription company, where if you subscribe to Netflix for $10 a month, Roku is going to take a portion of that monthly subscription cost. And that's just from allowing Netflix to basically be on their distribution platform. The advertising side is, if you have a Netflix subscription where they may show 4 minutes every hour of ads, 2 minutes of those ads go to Netflix and 2 minutes goes to Roku, and Roku generates revenue off the ads that they play. And so the thesis was, as more eyeballs basically go towards streaming, more people are going to be watching some sort of streaming content. Like Netflix now has the WWE, Amazon hosts the NFL. So what used to be appointment television for linear TV, which is like your legacy cable, is now shifting more towards linear, or more towards connected TV, towards streaming, and that would ultimately drive advertising revenue higher over time. And the interesting statistic was something like 50% of all hours at the time were spent streaming, but 30% of the ad dollars were on streaming platforms. So there was just a disconnect between how much money corporations were spending on advertising on connected TV or streaming compared to what they were spending on the legacy business. And over time, that 30% should transition more towards connected TV, towards streaming advertising. And so as it played catch up, that would be very beneficial and a high margin for business for Roku.
Okay, so we kind of got into like a prime time because the price had come down significantly from the COVID highs, and then there was kind of this lag period where ad spend hadn't shifted over to streaming, which was becoming the majority of how Americans are watching their TV.
Exactly. Yep.
Okay. So when we started this position and then throughout owning it, what was or were the biggest risks that you saw in owning this?
Yeah, one was, I believe, shortly before we purchased, Walmart announced the acquisition of Vizio. And so historically, Walmart's products, ONN TVs, were Roku. Roku had the operating system in those TVs. When Walmart buys Vizio, Vizio has, I believe it's the SmartCast or some operating system. They were going to transition, most likely, ONN TVs from Roku to Vizio. So that would be a loss on the distribution of the Roku operating system. And so that could potentially have been a negative and led to basically like lower account growth over time. The other risk was historically Netflix said that they would never do any sort of advertising on their streaming platforms. And on the surface, might not seem like a big deal, but what that did was Netflix is the biggest streaming platform. And so when they announced that they are going to start doing a lower tier, lower priced subscription with advertisements, that now increased the amount of potential advertising like slots or time that a Procter & Gamble or whoever wants to advertise on a streaming or connected TV platform can have. So if before, just say like the universe was 1 billion hours that they could advertise, when Netflix announces that they are going to allow advertising and there's now 4 minutes per hour for those accounts, that goes from like 1 billion to 1.2 or 1.3. So it's just an increase in supply. And that then meant instead of advertisers solely advertising on like the Roku channel, Roku's own proprietary system, they could now choose between like the Roku channel and Netflix. And so that basically depressed what they call CPMs, just the cost per thousand ad impressions. And over time, if more and more streaming providers allowed for the lower price advertising option, does that sort of diminish the Roku channel's place in advertising and sort of like their overall position to benefit from that shift of the 30% market, 30% of the advertising budget to a higher number over time?
And did we see either of those play out?
So I'm going to say for the most part, no. We saw more ad budget go to connected TV as anticipated. And what Roku did was they started partnering with basically like platforms that allowed them to fill a higher percentage of advertising slots in their Roku channel, in their other streaming services. So in the end, it was a headwind to the overall price advertisers were willing to pay. So instead of maybe prices increasing 5 to 10%, it might have increased low single digits because of that excess supply. But overall, Roku's partnerships with like the Trade Desk, with AppLovin, with other platforms that basically brought in different advertisers, more than offset that increased supply.
So this has been a fairly short ride compared to some of our other positions. I mean, February 2024 to today, July 1st. I mean, we sold even before this. So what was your original timeline expectation for owning the stock?
Yeah, my timeline was pretty accurate in that Roku was unprofitable when we bought it. And my timeline was over the next couple of years, they would go from GAAP unprofitability to GAAP profitability. And then through that, the potential number of owners, basically of the stock, whether it's through index inclusion or other investors, would increase. And my timeline for that was about 2.5 to 3 years, which is exactly what we saw. They recently announced that they're going to get included in, I believe, the S&P 400, which is the mid-cap index. So my timeline was around 3 years. They would get included in an index. That should ultimately have drove the share price higher. And then my thesis had been playing out really well. And what I originally set out was like $100 to $120, what I thought the stock was worth 2 years ago. But the business outperformed what I was expecting. And so therefore, like the valuation continued to go higher. And the price of the stock never got above where I thought it was worth. So we just continued to hold. And I thought we owned a really good business. So I was willing to hold Roku for an indefinite amount of time, as long as the thesis and the numbers continued to play out as expected. But the catalyst of index inclusion was one of the main parts of the thesis that could have led to a sale, because if you get a lot of indiscriminate buying, depending on how much buying pressure, it could have a disproportionate effect on the stock price.
Okay. You had shared like a little timeline with me for this position and our history with it, and you had changed your target price a few times throughout the history. Outside of like potential index inclusion, what other catalysts kind of led you to update your price target? Yeah,
the main one was the new CFO, Dan Jetta, came on a few years ago, and he has thus far had a profound impact on the company. It appeared the company was a little bloated beforehand. He has right-sized the cost structure, and his sole focus, anytime you ever listen to him, is how can we drive free cash flow per share? And that's like after they factor in stock-based compensation. So the figure that he was solely focused on is like the sole driver of basically the business valuation. And so when he's talking about that metric and driving operating leverage, operating margin improvement, I continue to get more and more comfortable that the CFO and Dan Jetta and CEO Anthony Wood are delivering on what they expected to. And the optionality when you buy a high quality business that is sort of like I don't want to say a one of one, but the best in class business, the range of outcomes on the good end tend to be a lot better than what you may initially underwrite in the beginning. So when you had two really good leaders at the helm, when the business performed better than I thought, I saw no reason to basically sell or cut my valuation, because they were just executing better than what I had expected. And so the main metrics we would look at were the active accounts and streamed hours relative to how much platform revenue growth they were driving. And those figures continued to come in better than what I expected. So that 120 that I initially thought it was worth continued to increase, because the underlying KPIs that I was looking at continued to come in better than what I was expecting.
Yeah. Another thing that you had in your initial write-up that I thought was interesting and kind of plays off what you're saying right now is the actual pay structure of leadership, which I know is, we want to have companies that are led by high quality individuals that are kind of incentivized accordingly to proper business growth and being sustainable.
Wrapping up the thesis in what happened from 2024 to today, basically platform revenue, which is the most important metric, it's a higher margin business, outperformed what the expectations were. The company continued to expand geographically. Right now, they were primarily a US company, but now they're looking at Canada, Mexico, and Europe. So their opportunity set is continued to expand. The cost structure got more in line with the overall business. And so while they grew revenues, anywhere from 15 to 18%, there was significant operating leverage, because SG&A or operating expenses was only growing maybe mid to high single digits. So there was significant margin expansion over time. And that led to just a rapid growth of basically free cash flow and earnings over the holding period. And the company announced a buyback a couple quarters ago. And we just saw basically a company with net cash of about $2+ billion, expanding their market, having margin expansion, increasing their basically TAM. And everything seemed to be going much better than I could have expected. And in the end, they launched a streaming platform or a streaming service called Howdy and Friendly. It looked like they were starting to get into having their own sort of original content or maybe partnering with other studios. And that is sort of where we come to today, where they could use their high value Roku home screen to drive traffic to Howdy or to Friendly and drive, instead of going to Netflix, you could drive traffic to Howdy or Friendly, and since Roku owned it, that would be just a more profitable subscription for them. And I guess just like one note, this whole time, there were several different reports that Roku was going to be up for sale. And I think the end game for them was always that they were going to get sold. It was just a question of to who. They were spun out of Netflix decade or so ago. And the whole reason Netflix spun Roku out was because Netflix did not want to appear to have some sort of conflict of interest of, hey, we own the distribution and we own the streaming service. So like an Amazon Prime or a Hulu, they did not want those providers to feel like they were getting sort of like the short end of the stick on Netflix is going to promote their activity instead of Hulu or ESPN or whatever it may be. And so to sort of keep everything separate, Roku was spun out to be just like an independent distributor. And that's sort of where we were as of a month ago.
Got it. So one of the very recent clear catalysts for change in outlook, changing your thesis, is the Fox acquisition. So how does that actually affect your outlook, and what led that to us deciding to sell?
Yeah, the acquisition by Fox makes a lot of sense. Fox owns Tubi, they own Fox Sports 1, and the one thing Roku did not have is sports. And so now that Fox will likely have the basically the home platform to drive viewers to an NFL game or to Tubi, it makes a ton of sense. The thing that I'm going to say concerned me the most, and why we ultimately sold, we could purchase Fox, but as of right now, we do not have any plans to, is that a lot of my thesis on like 2028 earnings stemmed from the political cycle. And when you have Fox buying, Fox, which is everybody knows it's a political platform, now has control over distribution of advertisements, of where eyeballs are going. I just worry about how that fits into the broader political advertising landscape, and just the day and age we live in. People are so, I don't want to say they're like one side or the other, but their purchase decisions are affected by their political views. And now that Roku is owned by Fox, do people's views on owning a Roku TV or wanting to watch the Roku channel, is that going to be affected by whichever side of the political landscape you're on? That's one side. The second is, I don't know how much companies will want to be affiliated with a certain party. I.e., if I am, I'll just keep using Procter & Gamble, and I want to advertise on the Roku channel. Well, the Roku channel is now affiliated with Fox. Is there going to be some sort of backlash against Procter & Gamble by people that are not on the same political side as what Fox promotes? So does the overall potential advertising pie that Roku has the ability to capture, is that now shrinking? And I'm going to say the worst part is political advertising is so much more higher margin, generates significantly more just like EPS during that couple quarter political campaign cycle. And I just don't know how that revenue stream looks given the new combined company. And so they've disclosed in the past how much political aided in certain quarters in terms of revenue. And just when 2028 comes by, that, in my opinion, was going to be like the ultimate inflection of campaigns are not going to focus so much on the legacy like linear radio advertising. They are going, this like 2028 is the inflection year of, you're going to see a lot more advertising on the political side, on connected TV, on streaming, wherever it may be. Roku has the Roku home screen. Like, I thought that was going to generate a significant amount of revenue for them. And now I really just have no idea what that looks like. Yeah. And so one of the reasons why we sell is if our thesis materially changes or the potential range of outcomes is a lot different than what maybe we initially underwrote, then it is totally okay to sell the position, re-underwrite it, follow. It's a totally different story today than it was, a year ago. So we'll take a step back. It was a great investment. We'll now follow Fox. It's not a company that I have great familiarity with. I know what they do, but in terms of the actual business profile, I'm not 100% in tune with it. So no harm in stepping aside, reassessing the business. There's going to be some, when there's an acquisition and integration, there's always going to be some sort of cost reduction or synergy. There's just going to be some hairiness to the story over the next year as the two combined companies get integrated with each other. I don't really think the Fox stock will get away from us in a meaningful way, and it allows us to just take profits and redistribute them to other ideas that we think may be better.
What was our original purchase price for Roku?
It was around $60, and I believe we bought one other tranche around 52, but depending on when the client may have come on, the purchase price may be different. But that's when our
Still has been a great ride.
Yes, it's been very good.
So Roku still is a top player for smart TV, connected TV, streaming platform. If companies are deciding because of the affiliation with Fox, hey, we don't want to spend with Roku now, where is that going to go?
It'll likely go towards Amazon's got Amazon Fire TVs. It could be like the ONN Video Smartcast. It would likely just be some other operating system besides Roku's, but they'll still advertise on Netflix, Hulu, ESPN, things like that. But the Roku, it'll really be like, instead of advertising on the Roku home screen or the Roku City, you're going to go advertise on Vizio's or Samsung's, whoever's operating system that you want to.
Still shifting to streaming though for ads.
Exactly. Yep.
Okay. So all in all, look back at the time we've owned Roku. What are your biggest takeaways from just this journey?
In October of 24, several months after we made our initial purchase, the company came out with what I thought were phenomenal results. I think platform revenue might have grown like 21%. And every underlying metric looked really healthy. And on the date of the announcement, the stock dropped around like 20%. And I could not find any rational reason why the stock was down. And then when I read what some of the reports are afterwards, it was basically Roku did so well that something that I'm going to say short-term, like the short-term pod shops, the short-term investors look at is the revenue accelerating or decelerating? Basically, is revenue growing at a faster clip or a slower clip moving forward? And Roku did so well that instead of revenue accelerating in the subsequent quarters, it was now going to decelerate. And these are marginal. It was marginal at best that this was going to happen. And so basically every report came out and was like, Roku did so well that there's no way they can like basically top it again. And that's why the stock is down. And I'm like, doesn't really make sense that you're kind of punishing the company for doing exceedingly well. So when that happened, we added to our position. And I think like the big sort of takeaway is that when you have more than a quarter or 2 quarters of a time frame, like it allows you to add to a position that is still tracking your thesis. No part of the Roku thesis was ever really off track. The only thing that ever concerned me was their player segments, so like the dongles, the TVs, was continually underperforming what I thought. And is that like a precursor to the number of like streaming accounts or active accounts on a Roku platform? But I was not as concerned about that. So everything was playing out as expected. And the stock was down 20% below where we purchased it. And I thought it was just like the craziest reason to sell the stock was that it did really well. So one, having a long-term time horizon and being able to add on weakness, I thought was sort of just like a really good like moment in time of we still like it. Market for whatever reason is killing it, and the business is very healthy. So I don't know. It's sort of just like just showed our process, I would say, in real time that we're not going to trade on a quarter or 2 quarters numbers. We're going to look at what the overall business is worth.
Yep. Kind of a bittersweet thing for you too. I know this has been like a favorite position of yours for a while. So
yeah, every time I would go in,
well, but it's kind of a shock.
Every time I would go into like a Target or a Best Buy, I'd be like, I'd tell my girlfriend, hey, I got to go back to the TV section to see what the supply on the floor was. And like our Roku, yeah, a Roku's getting sold, or Samsung Vizio who's getting sold. And now it's one less trip to the store, but it's okay.
Yeah. I have one last question for you. Do you know what Roku means?
5? Shoot, 3?
6.
It's a number.
6.
Dang. Yeah.
Yeah, because it was Wood's 6th company.
That's right. Yeah.
I just didn't know that. That was interesting.
Yeah.
Anything else you want to add, Dom?
Nope, that is all.
All right. Well, thanks for joining us, everyone.
Thanks, Grace.